if the gold is the money, then every time the price of gold moves, it's revaluing the dollar. Gold doesn't actually get revalued. The dollar is being revalued. Now, the question is, are we talking about statutory revaluation or market-based revaluation? You just cited two examples, one being 1933, which was statutory, right? FDR just decided, maybe on some advisement, maybe on a whim. I remember I read when I was turning libertarian when I was younger, I was reading one of Glenn Beck's books, decide if he's the path I wanted to go on. Ultimately, no, it wasn't. He was an influence, but I never really went down his path. But he was talking about, I think in his book, Broke, how FDR just decided on a whim to make it 35. I don't know. He was just like flipping numbers in his head and he decided that was the one. Could be true. I don't know. And then you were talking about the revaluation in 1980, where the price of gold in the market that you could get a gold coin for to shop was what was being revalued. And that hit 872 or 850, wherever you want to count the top.
The global financial system is entering unknown waters. U.S. debt has skyrocketed, interest rates are stuck, and dollar stability is tenuous. U.S. dollars have been the world's safe haven for decades. Trust is disappearing fast. Revaluing gold will be required when a breaking point is reached. According to financial analyst Rafi Farber, inevitable. Farber predicts a fundamental shift in value measurement, not merely another cyclical downturn or banking crisis. He believes the dollar is a derivative of gold. Most investors ignore the notion that every gold price change is a dollar revaluation. When the system realizes this, gold will need to be repriced considerably higher to restore Federal Reserve credibility. How high? Farber predicts that gold is worth $40,000, $50,000 per ounce, based on the monetary base and the U.S. Treasury's modest gold holdings. Numbers that seem crazy are based on history. As in 1933, under FDR, and 1980, when the free market forced revaluation, the impending crisis will require gold to again underpin money. When that happens, silver, frequently neglected but historically more explosive, might gain much more. Today's video features Rafi Farber explaining why the dollar's credibility is eroding. A gold revaluation is likely, and investors must realize the ramifications before it's too late. Stay tuned. This is not guesswork. History is repeated in real time. Before we begin, please like, subscribe, and set on notifications to never miss important insights like these. Please enjoy the video and thanks for supporting us.
And to take it seriously, like people treat it like, oh, it's just a religious statement, like, God is one, whatever, but you don't really know what that means. But you have to understand what it means that gold is the money. If the gold is the money, then every time the price of gold moves, it's revaluing the dollar. Gold doesn't actually get revalued. The dollar is being revalued. Now, the question is, are we talking about statutory revaluation or market-based revaluation? You just cited two examples, one being 1933, which was statutory, right? FDR just decided, maybe on some advisement, maybe on a whim. I remember I read when I was turning libertarian when I was younger, I was reading one of Glenn Beck's books, decide if he's the path I wanted to go on. Ultimately, no, it wasn't. He was an influence, but I never really went down his path. But he was talking about, I think in his book, Broke, how FDR just decided on a whim to make it 35. I don't know. He was just like flipping numbers in his head and he decided that was the one. Could be true. I don't know. And then you were talking about the revaluation in 1980, where the price of gold in the market that you could get a gold coin for to shop was what was being revalued. And that hit 872 or 850, wherever you want to count the top. And ultimately, these are really the same thing. Right, they're brought about in different ways, and that's but they are monetarily speaking. What is happening in the monetary system? It's the same thing. It just the difference is who's acting upon it. Like if a 50-kilogram weight drops on your head, you're not going to really care that much if it was, like, say, a meteor from God. Or let's say somebody had sinister would drop something on your head from 100 feet above you, or drop the piano on you. Either way, you're dead. It doesn't make a difference. So I don't think we're going to have a statutory gold revaluation. And what happens during the statutory gold revaluation? Well, you look at the price inflation statistics, which we have from the 1930s. And in April 1933, I think the deflationary, and I'm talking about consumer prices, the deflationary statistics were something like -9% a year. And then by about 10 to 12 months after the revaluation from 21 to 35, price inflation shot up to positive 10, 15% or something like that, like a huge move. And really that was the point, because by revaluing, that gave FDR's government, or the Fed under him or beside him or whatever, the ability to print more money based on that gold revaluation, and then the inflation came from there. But in 1980, it was by the market itself, when the market decided that the other stuff on the Fed's balance sheet was not trustworthy. So it bid up the value of the gold to back the rest of the assets on the Fed's balance sheet, which is mostly debt, to 100%. And that made the rest of the debt trustworthy. Now the question is, what percentage of gold backing the rest of the Fed's balance sheet would make the rest of the treasuries trustworthy to hold for people? And if we go to the 1980 numbers, it's something like $40,000 to $50,000. So people think of that number and they're like, oh, this guy's a crazy gold bug. But it happened before. And once it happens, I'm going to get rid of my gold. I'm going to buy stuff. I'm not going to buy dollars. I'm not going to sell it for dollars. I'm going to buy things. And I'm going to call it the end of this game. I'm going to move on with my life. And we'll see what I do after that. But I know where the bell is, because we've had 1980. So that's what I'm waiting for. Kinds of dollars out in existence. Right? There's the monetary base, which is the stuff that's on the Fed's balance sheet. Right? When the Fed buys an asset, it creates new dollars and gives them to whoever gave them the asset. That's base dollars. And then you have commercial bank deposits, which are created through loans and other activities, which are built upon that base. So the number 40, 50,000 is based non-commercial bank money and not on the M2. The M2 is base money plus all the loans that are made piled on top of it. Just talking about the monetary base. The monetary base itself is the balance sheet, and all the assets on the balance sheet. And then you have a little bit of gold, 235 million ounces, the unaudited, whatever. Let's just assume it's there. So if we were to take the monetary base and take all the value of that in dollars, and then the tiny amount of gold it has on its balance sheet, 235 million ounces, if we are to equate the dollar value of those 235 million ounces to the rest of the pile on the balance sheet, which is the monetary base, it would have to be I think it's about 50,000, or it could be 55,000, somewhere around there, like between 40 and 50 or something like that. It doesn't really make a difference. But that's what we're talking about. I'm not talking about covering M2. I don't think we're going to get there, because to cover M2 is what, like 21 trillion, whereas the monetary base is like 5.6 trillion. It had to be 4 times that. I don't think we're going to see $200,000 gold. I think the dollar's going to break before that. So
Farber demonstrates that market-driven revaluations like the 1980 gold spike and Roosevelt's 1930s legislative revaluations are the same. Both reduce dollar purchasing power and boost debt market confidence. Whether by government or free market pressure, inflation will redistribute wealth and remind us that gold is the system's anchor. The same mechanics operate now. Farber thinks the market will act before policymakers. The Federal Reserve is trapped this time, with no clear options. It risks hyperinflation by cutting rates as consumer prices rise. The weak banking system could collapse if it doesn't cut. Farber says this is no longer about recession prevention, whether to sacrifice banks or currency. He explains why this perilous juggling act and political tricks like the Genius Act and stable currency cannot change reality in the next part. The bottom of the debt pyramid is gold. When cracks widen, the building shakes.
How much they believe in what they're saying, these position papers, and how much is propaganda and how much they're just making it up. I don't know. But the way that they're thinking about it, they say, look, we have this gold. It's not really 42. If we just stop lying, then we have all this free money and we don't have to raise taxes and we don't have to increase the debt. it seems like free money, right? How could you go wrong? And if you don't understand that gold is money, and if you revalue the gold dollar ratio, you're not changing what money is, you're changing what the dollar is. And if you change what the dollar is, that affects all prices down the line very quickly, not overnight, but within, months. When FDR did it, it was a 66% revaluation. It took about a year to get to maximum price, consumer price inflation. So if you don't, I don't think anyone in the government understands that gold is the money right now. And because they don't understand that, they see this as like a mathematical trick that can just, give them manna from heaven, free money. And they say like, why don't we just do that? And then the only reason they don't, I think, is because maybe there's some traditionalist people, or maybe they don't fully buy into their voodoo. And they're like, maybe this is not such a good idea. It's like Louis C.K.'s famous comedy bit, of course, but maybe, of course, free money is great, but maybe destroying the dollar isn't such a good idea. They're not sure about it. So we'll see what they do. And if they don't do it, always the either or. When we start playing the inflationary game, you are playing the game of the currency versus the banks. You can save one, but not the other. And now, as you go up the pyramid, you can juggle, right? So as we go up the pyramid, this pyramid, let's say it started in 1933 with that initial revaluation. Then you can juggle that pyramid and only hike when price inflation goes higher, when consumer prices go higher faster, and cut only when they stop accelerating as fast. And the reason you can keep juggling is because of the analogy that I often use, the apple tree, the orange tree in your backyard, right? If you have incredible production, you don't notice that your neighbor is stealing from you. But if your neighbor invites his cronies to his your backdoor neighbor, and they want to eat more and more and more oranges, which is the equivalent of the government growing bigger and bigger and bigger, because that's how it always happens, then you can keep consumer prices lower by increasing productivity. But there's a point where you can't increase productivity any longer, and you're overburdening the slaves, and they can't make the tree any more productive. So at that point you have to start cutting into an accelerating consumer prices environment, which is where the Federal Reserve is headed now, because this is what just happened like a week or two ago, right? They were urging Powell the Trump administration was urging Powell to cut, and he was saying, he hinted no, he's not going to do it because consumer prices are rising too fast. And then he came out in Jackson Hole and said, well, we're going to cut now. And then gold and silver jumped. Consumer prices are rising faster than at any time from 1980 to just before COVID. So they're going to be cutting into a higher consumer price environment, and that means they will destroy the currency. Until now, they've always only cut into what they call recessions, when consumer prices stop rising and you have this huge banking crisis. So you can pick, I'll save the banks, and the currency will level out in consumer prices. But now they can either trigger hyperinflation by cutting to zero in an environment of very fast rising prices, or they can not cut at all and let the banks fall, and then everything goes with it, and all prices fall, consumer prices too, but they fall the slowest compared to everything else, including assets like stocks, bonds, Bitcoin, all those other things. Consumer prices still fall, but however it goes, it doesn't make a difference for gold and silver holders, because all the purchasing power goes into those metals anyway. Okay, so I'm guessing here as to a causal or a rational, let's say, Austrian view of what is going on, or a positivist view. You try to link it up to why humans would behave in such a way that this would precede a financial crisis. So I think what you're talking about is, there was a chart that I saw on Gold Charts R Us of the gold maturities from all the way to the farthest out future. And I noticed that in 2007 up to the 2008 financial crisis, the spread really got pretty thick, right? And also in 2019, from the repocalypse, from when the repo rates started to spike up and the Fed had to restart QE, until and especially through 2020 during the lockdowns, they really got pretty thick also. And they're doing it again. It's been that way since, I think, 2023, since the regional banking crisis. I might be a little bit off on the dates. I haven't seen the chart in a while, but why would this be? And I don't have a perfect answer, but if there are problems with the dollar, then what you would see is spot gold going pretty high relative to other maturities, and but going out into the future like I think you would compress in the middle, and then the price would go higher out into the future because you'd have speculators that are also worried about the dollar, because they want to they're using gold to speculate because they see something wrong with the dollar, but also you have the people at the very at the mouth of the pipe, the big banks, and they are going after spot gold itself. So you're having these like kind of zigzaggy, wavy maturity scheme, and I think that's what's happening now. But you'd have to look at a chart of this. It's available on Gold Charts or us to see all the maturities and the different colors of the lines, and they get wider as we get closer to a crisis. So the chart goes back to, I think, 2005, 2006. The only time I've seen the maturities be this spread out are 2008, 2020, and now. So the question is it happening again? And there are other signs that corroborate it. How far out are we? I don't think we're very far. People say, like, I've been around since 2020 saying the same stuff, but it's 2025. Even 5 years is not that much time. I know that's kind of a cop out, but it's also true. And gold is still money. I mean, it doesn't really matter because I know what the truth is. People can say what they want, but
Rafi Farber's analysis shows a harsh truth. The U.S. monetary system is tipping. The Federal Reserve is stranded with its balance sheet stretched to extremes and inflation much above historical norms. The $33 trillion debt bubble might explode if rates are raised rapidly, but stopping or reducing would spark inflation and further erode dollar credibility. Whatever the case, the dollar's decades-long confidence game is collapsing. Historical evidence shows that trust never returns. Gold and silver are signaling this change. Recently, gold's trajectory has varied substantially from official inflation estimates, suggesting it is secretly pricing in systemic stress. Silver, meanwhile, trades at a huge discount to gold despite its industrial importance and centuries-old monetary history. Silver's price might soar tenfold if the gold-to-silver ratio returns to historical levels. This imbalance cannot last, and the correction will be violent. Farber's prediction that gold's fair value may reach $50,000 per ounce based on the current monetary base is mathematical. When governments collapse their currencies, markets re-anchor to real money, and the magnitude of paper claims implies gold and silver must be revalued astronomically to restore balance. Those who dismiss such numbers as fiction ignore economic history. Whether Weimar German, 1970s American, and current Argentina and Turkish fiat regimes always crumble under excess. The only question is when. The chance is limited. When confidence drops, markets respond quickly. When the mainstream rushes into metals, supplies will dry up, premiums will skyrocket, and typical investors will be locked out. Already, sovereigns, central banks, and billionaires are secretly accumulating gold and silver, while retail is scarce. This growing gap between smart money and the masses is the final warning shot before repricing occurs. Clear message. The system reset will favor those who prepare now. Gold and silver go beyond hedges. They are lifeboats amid a central bank-caused storm. If you enjoyed this breakdown, like, comment, and subscribe to avoid missing our next deep dive into the monetary crisis. In the meantime, stay informed, prepared, and stacking. Thanks for watching.